Hi, everyone. Thanks for joining us today for spring cleaning, how to declutter and clean up your GP chart of accounts. Just a little housekeeping before we get started. The webinar is being recorded and a link to the recording will be sent out to all of you following the presentation. Please feel free to submit your questions in the GoToWebinar panel. On my screen, it's on the right-hand side, and any questions that come to mind during the presentation, go ahead and send them in. We will take time at the end to answer them. I should also note there are free trials of any of the applications we talk about today at crgroup.com/GP-addons. So if you're interested in any of them, they do generally work with the Fabricam company, and you can download them and take a trial through them. Just a bit about me. This is John you're speaking with, Director of Enterprise Business Solutions here at CRG. I have worked at CR Group since 2003. I've worked with GP since 2000, I think it was 2000, so wow, 20 years. Version 6 is where I started. And over the last 17 years at CR Group, I've been involved in many chart of account restructures, all the way from big numbers of accounts, like restructuring a client. The very first one was a healthcare place in Florida many years ago that had like 240,000 GL accounts that we worked with. So hopefully today I can impart a bit of wisdom over the years of all the clients that I've worked with and what we've seen. So just a bit about who we are. It's Corporate Renaissance Group, as many of you know. We've been around since 1989. We are a Microsoft partner with offices globally. We have a big team of people that work specifically on Microsoft solutions, and we develop other add-on products for Dynamics GP. And of course, nowadays we are also into Dynamics 365 and everything that means. The Power Platform, CRM, ERP, Business Central, Dynamics 365 Finance and Operations, which is now called Dynamics 365 Finance, the whole thing. And then we also support some other solutions, specifically in the corporate performance management space, Board Adaptive Insights, Rapid Start, and IDU Concept. We have a very successful human resources product called mPerform, and we'll touch on that later today. Our agenda is really to focus on the chart of accounts. We'll talk a little bit about how GP gets messy and what we can do with that. We probably have lots of horror stories. Maybe you're living it. What are the best practices for cleaning up the COA? How do you do it? I also want to touch on just a couple of other pieces that are important, multiple companies and maintaining your COA. So that's really the focus of today's presentation. I think we all know, if we've lived in GP for a while, how it can get messy. So many different things come to mind. Organization structure changes, intercompany transactions that aren't flowing correctly, patchwork reporting, new integration needs, multiple companies with different chart of accounts set up, too many GL accounts, the list goes on and on. And I think the one thing that's important to point out here is that just because it gets messy, it's not uncommon. It's almost like it's a bit of a fact of life in an accounting system. I don't know that this is really a GP issue, if it's just sort of the nature of businesses that change and how we report, how we record, that cycle of record to report, it has to follow the business structure. And I think in any ERP, it wouldn't be uncommon to see a need to restructure a chart of accounts. For this specific presentation today, I mean, we're focused on GP, so that's what we're going to talk about. But if you're in this situation, living with a messy COA, you're not alone. There's lots of other organizations out there that are probably in the same boat. And the second thing is, I don't really think it's anything to worry about as much as it is, let's get through the exercise of cleaning it up. So I think right off the start, one of the important things we've always tried to talk to our clients about when we talk about reporting, which is obviously, the key output from the chart of accounts, is bridging the amount of information we keep in the general ledger with leveraging the rich information that's kept in the subledgers. So if you think about sales reporting as an example, right, there's a tremendous amount of value in doing your sales reporting out of the sales order processing subledger in GP. You can see some of the richness of that data if you were to look at a smart list for the sales documents or the sales line items. Certainly, you'd start to see a lot more richness if you looked at the analysis services cubes for GP and specifically looked at the sales one. So, the reason I bring this up is that sometimes when we get into the chart of accounts tree structure, we see general ledger COA structures that are overburdened with accounts or dimensions because they are trying to satisfy organizational reporting. And it's almost if the paradigm was, well, if it's not in the chart of accounts, we can't report on it. And really that's not true. We like a lean chart of accounts that's used for, good financial statement reporting, management financials, actual versus budget, drill down to transactions, all that good stuff. But if I was running stuff like sales by region, sales, gross sales, by customer, by product, by item, all of that stuff can come out of, for instance, a sales subledger. So going into this, let's make sure we got the right balance and understanding that we're looking at it from the right paradigm. Let's keep the GL focused on financial reporting, and let's look for a lot of analysis and richness from the various subledgers in GP. I only used sales as an example, but certainly there's AP, AR, inventory, project accounting that are full of great stuff, manufacturing, etc. Okay, so what do we need to consider, or what are the key items really for cleaning up and knowing that we have a really good COA? Well, I think the first one is consistency, right? We drive for consistency of reported information across business units. So, this can mean that we're in a multi-entity scenario. We want to make sure when we look at one of the businesses that the structure is consistent with the other businesses that are under the umbrella, for instance. That can also mean between cost centers and business units as well. Ease of consolidation of information. So again, Management Reporter has a fantastic consolidation capability. It works really, really well. I've used it with many clients, and it allows us essentially to create a tree in Management Reporter that maps in the various legal entities under a company structure. It continues, by the way, to be used with the D365 Finance product. And if you know that product, you know that that's positioned at a higher end enterprise level client. And many of those clients have multiple entities, like 25, 50 entities. And, we use the data warehouse and Management Reporter to run the consolidation. It's capable of multi-company, multi-currency consolidation. So really quite strong capability set there. However, if you try to run the consolidation with different charts of accounts, you're going to find it'll do it, but you're going to find it creates a lot of extra work. So it's really, really important when we think about the COA in a multi-entity scenario to make sure we have, a similar structure to ease consolidation of information, make reports easier to generate, and satisfy management requests. Ability to benchmark between different business units, areas, and entities. So again, same thing, right? If we're looking at one business unit, let's look at the other one the same way. Let's ensure that when we look at office administration expenses, that they're all stored in the same numbering sequence. Or if we're looking at salaries and benefits between different business units or departments, they're all stored in the same number set. And I bring these up because I've seen this over the years. I've seen, one department's salary and benefits down in a 6,000 series accounts, and another one's hanging out in like the 8,000 series. And you look at it and say, well, why did you do that? Why is that set up that way? And it may have been a reason many years ago, but it may be something that we can look at and change. So benchmarking and ability to benchmark needs consistency. Reduced learning curve. As we bring people in, it would be really nice to be able to provide them with a chart of accounts manual that says, hey, here's how we set up the chart of accounts. It's really easy to learn. It follows common best practices. You've probably seen similar structures at other organizations. And, we want to reduce the time spent on reconciliation procedures. So we want to make sure we've got a nice, tight, clean chart of accounts to help with that. We also want to build in flexibility for growth. And I think sometimes this one might be the big one that causes a lot of the aggravation that contributes to the requirement to restructure the chart in the first place. So if we built a chart of accounts originally that didn't have room for growth, if the segments aren't, 10 digits apart or something, sometimes what we see is accounts have to be added and they can't be added in the proper sequence. because the chart wasn't built to allow growth. So we need to consider that when we're rebuilding the chart of accounts. So when we look at GP, we have a lot of options. And, one of the things we love about GP is its multidimensional framework. And as you know, the multidimensional framework is centered around that multi-segment structure in the chart of accounts itself. You can have a maximum of 10 segments in your GP chart of accounts. I personally don't recommend that. I have worked with clients that put 10 in and they very swiftly tried to reduce them. I don't have a best practice here, except I'll say that what I find the most workable number of segments is between 3 and 5. I think as soon as you start getting beyond that, the coding exercise and the understanding and the commonality, and it just becomes very difficult. Also, when you start considering the combinations and permutations of, say, 6 or 7 segments, your chart of accounts will probably explode when you think about how many account strings you need to map those together. But importantly, GP is more than just a multi-segment general ledger account. It also has account categories on the account master. Those are required. Sometimes people ask me, well, why do I have to, when I create a new account, put a category in it? Because I don't use the category for anything, but it's a required field. What you may not know is that the category is an excellent place to drive management reporter reports from. When you build your row definitions in MR, you can pick up the category, so strongly recommended there. We also have UDF, user-defined fields 1, 2, and 3 on the GL account card. Again, those can be mapped into management reporter. Sometimes when we're doing newer implementations or we're doing a COA change, we will actually use like user-defined field 1 to say, this is what the old account number was for the specific account you're looking at. So then right in the system, there's a mapping between the new account, which is the account number, and the old account, which is stored on user-defined field 1. We also have analytical accounting dimensions. So, when we look at these in the system, you're probably familiar with the account format setup, the account framework. That's the picture on the left where we go set up our segments and define what they are and what their lengths are. When we look at the actual account card, you can see on there the account number, the description, the category. Those red fields are required, but also important there is the user-defined fields on the bottom portion of the screen. Analytical accounting is another piece that is something we like to talk about, because analytical accounting allows us to break out the chart of accounts and really tag transactions against other financial dimensions that can be reported on. And you see some examples here, common things like an employee or project or an event for marketing or training initiatives are all things that are really well suited to analytical accounting. When I do demonstrations with GP, I usually use an example here where I say, hey, let's suppose we have a travel expense account and the controller has said every time we put a debit into that account, every time we expense something to it, I must have the employee that's associated with the expense. So in that area, we would set up an analytical accounting dimension for employee, and on the travel expense account, we would say that an employee AA code is required. In other words, you can't post there without one. And so that's a great way to understand analytical accounting. For those of you who are considering a move potentially down the road at some point to Business Central, this is also an important concept, because in Business Central, it's a single segment chart of accounts and it's supported by financial dimensions. The financial dimension framework in Business Central has a little more logic around it than GP, simply because it allows us to apply financial dimensions by default at master data, meaning that we could say on an item, a product, a customer or a vendor, this is the financial dimension required. The only reason I bring that up is you want to think a little bit about this. You want to think about the fact that, hey, we're living in a multidimensional world. GP supports it today. And any system you ever move to in the future would also support this multidimensional structure. CRG, we're big fans of analytical accounting, and we've done a lot with it, and we have some tools to support analytical accounting that we can talk about. The big thing about GP's multidimensional structure is that when you go into Management Reporter, from a Management Reporter perspective, one is not better than the other. In other words, if you see on the screen in front of you, what am I looking at here? The highlighted area on the left is the 3 segment accounts, right? It's the account structure that's broken down into the main account, the class, and the sub account. Those would be the 3 segments in the account string in this example. On the right side, I'm pulling in some other pieces. What are these other pieces? Well, the account categories there. That came right off the GL account card. User defined 1 is there from the GL account card. And then consulting revenue by employee and XYZ are analytical accounting codes. But if I'm management reporter and I look at it, they're just all financial dimensions. Management reporter doesn't really care if it came off the account card or it came from analytical accounting. It just wants to know, hey, I stored this information on the transaction. A posted GL transaction went to an account segment. That account has a category. That account has a user defined field 1. And by the way, it may have some analytical accounting tags associated with it. So let's think strongly about the reporting needs and the multidimensional reporting needs when we think about restructuring this chart of accounts. So once we've got through the basics of that and we understand, hey, GP's got all kinds of options for us, where do we start? How do we do this? So let's talk about segments versus AA, because segments versus AA there's no hard and fast rule on this. What should be in a segment? What should be in analytical accounting? You know, how do you do that? How do you decide? What's the logic? Let's talk about it. COA segments are really good things for statutory financial reporting. I said earlier 3 to 5 and 5 max, and that's a subjective comment from me after all these years of doing COA changes. But I really think as soon as you get beyond 5, GP gets you can work it. It's just not the best. That being said, you need to allow in the segments you have enough digits for growth, right? So if you're a organization that has lots of cost centers, you know, having 2 digits for cost center doesn't make sense. You probably want 3 so that you're not limited to 99 cost centers, you're limited to 999 in the future, right? Likewise for the main accounts, you know, usually 4 digits on main account. A lot of our clients use 5 just to keep them nicely sequenced. Think about that as allowing dimensions for growth. One of the things that I really point out is that where a segment comes in on the chart versus analytical accounting, for me comes down to, is that dimension going to be there forever? As long as we run this business, will we report that way? Is it a long-term dimension? And long-term stuff like cost centers, departments, you know, maybe projects, business units, those are ideal in a COA segment. It goes without saying your main account is always going to be a segment, but the other stuff you could say, well, project, John, gee, I could put that in analytical accounting, and you could. A department, you could put it in analytical accounting. But if those things are going to live with the client forever, if it's going to live in the company forever, if it's always going to be a key segment for financial reporting, I would put it in the chart of accounts segment. With analytical accounting, it's more about management needs. It's softer stuff that we want to track there. It's stuff that's short-term in nature. So, right, so like an ideal scenario here might be something like a marketing event, right? We're going to go to this, we're going to sponsor this marketing event. We're going to accumulate a bunch of costs, but the event happens in September or October. And once we're through the event, we're never going to track anything against it again. So why would I create an accounting segment for that? Because it's a short-term need, right? It's better suited to analytical accounting for an example like that. So think about long-term stuff as a segment and short-term stuff as analytical accounting. And I think if you do that, you'll get the right mix. Now, the other thing we want to talk about is sequencing of these accounts. And this continues to surprise me that most organizations don't follow this. We know from, if we go back to sort of accounting school, which was just some of the most exciting reading and studying I ever did in my life, getting my accounting designation, and I'm tongue-in-cheek saying that, I'm kidding, of course. But one of the things that becomes very clear is the chart of accounts should be ordered in liquidity order. This, what I have in front of you, is really common sequencing. And I see this used across all kinds of ERP systems. You know, we support clients who have other ERPs. I'm involved right now supporting a Workday implementation. And you know, this is what people use. This is what's out there. This is the commonality. And Fabricam may have something that alludes to this. 1,000 assets, 2,000 liability, 3,000 equity, 4,000 revenue, 5,000 cost of goods sold. Then when you get down to the 6, 7, 8, 9s, it becomes a little bit, well, how do you break that out? My recommendation is you keep the HR related stuff for people in the 6,000 series, that you move general operating expenses to 7,000. That 8,000 is reserved for non-operating items, meaning things like interest expense and foreign exchange gains, losses on disposal of capital items. Some people put depreciation down there as well because they may be driving like an EBITDA calculation and they want to keep all the interest, depreciation, amortization stuff in its own, below OPEX, in its own sort of sequenced area. And then 9,000 for unit accounts. So, any statistical tracking accounts in the 9,000 series. And this works really well. We've put it in at basically every client we've ever worked with, and it has always worked extremely well. So let's make sure we have proper natural or main segment sequencing. We also want the numbers to mean something. So, let's think about this. When we look at the segments, we want numbers to mean something. I get this a lot too. Well, we track by division and department. And then I say, okay, do departments roll into the division? And the answer is yes. So then I tell the client, you don't need 2 segments to track that. You need 1 because it's too duplicative, right? I don't need to type in for rent, it's account 7100, the division is G&A, so 100, and then the department is finance 100. So I'm gonna type in 7100, 100, 100. I could just have it as 7100-100. And if in the departments I order them in a numeric sequence that makes sense, in my example, I would implicitly know any department in the 100 series rolls up to G&A. Any department in the 200 series rolls up to sales and marketing. So if I was creating my management reporter reports, I'd be able to say 1 star to grab G&A and 2 star to grab sales and marketing. And it's going to make my life a lot easier. So think about these segments that way. Is there a way to sequence the numbering to draw more than one conclusion from a single segment? And the bottom section of this slide is a good way to think about that. So if we do that, we can also think about, all kinds of companies in GP. And, we at CRG have spent a lot of time in GP's multi-company scenarios. We actually have a product called Company Consolidator that brings Company Combiner, that brings companies together. If you have multiple GP companies, we work with Binary Stream because they have a multi-entity solution for GP as well that allows you to store, multiple GP entities inside one company. And you may want to consider that. It can save some time logging in and out of GP. It can help you with your reporting. It does mean if you put multiple companies into one legal entity in GP or into one company in GP, it means that you end up with a company segment so that you can separate one company for the other. But it may be something to think about, certainly something to talk to your GP partner or us about as required. So if we've decided that we've got a COA structure in place, how do we go about doing it? So we do have some add-ons that are tried, tested, and true, and used over many companies over the years to help them achieve these objectives. I think CRG is still very well known for Changer. We were the original GP Changer product that allows us to change chart of accounts numbers and merge the chart of accounts, different accounts together. It allows us to change, merge, and combine the GL accounts, and it spirals through history as if the new GL account structure was in place from the very beginning. Changer also works with item numbers, employee codes, project codes, vendor codes, and customer codes. We also support a chart of accounts restructure with Reformatter. So if your account format is locked and you want to add a segment to it, but you can't because you or your partner locked the framework when you deployed GP, Reformatter will allow you to break that lock and extend the number of segments that you have in the system. And it's the only tool out there that will do that. So if you're in that situation, you need it. If you're considering using analytical accounting, we have some unique tools in the analytical accounting area. They help us you know, move analytical accounting, move segment data into analytical accounting. So say you were tracking project data in a segment and you decided, you know, I'd rather have that in analytical accounting. We actually have a converter that'll pop the history from the segment to analytical accounting. And then you can go run changer to get rid of the underlying segment in the chart of accounts, and all that history will be sitting in analytical accounting. And there's some other tools in there as well that work really well. There's an analytical accounting changer as well. And I already alluded to Company Combiner earlier. Company Combiner allows you to pick a parent company in GP and essentially migrate other GP companies into it. If that's your situation, let us know. We've worked with large data sets where we've combined 75, 80 companies into one before. So really a lot of effective use of Company Combiner out there. And then the other thing we just mentioned, I mentioned off the top, CR Group has some great solutions. We have an award-winning employee performance management product. We have a ton of Dynamics customers on it, and it manages the full cycle of employee performance review, 360 feedback, ad hoc check-ins, you know, continuous feedback, has a 9-box. It does compensation planning as well. So a really good tool. And likewise, we have budgeting solutions from simple to sophisticated, from straightforward to totally modeled around the business. We also have some costing tools. Multi-level cost allocations in GP are supported with Cost Allocator through to full-blown activity-based management using our Flex ABM tool. So those are some other great CRG solutions. I don't see any immediate questions coming up. I'm just going to take a second to see that any that have come in. And there is one question. The question is, to change the chart of accounts, do I need both changer and reformatter? So the answer to that question is, you certainly need changer. You may or may not need reformatter. It depends whether your account framework is locked. So if you go ahead and go look at your account framework, it'll tell you the maximum length. It says right in the window. And if it's set as 66, you've got nothing to worry about. But if it's, say it was set originally at 9 characters and you know your new framework needs 12, then you are going to need reformatter. Another question out there, does MPerform support smaller size clients? The answer to that question is yes, MPerform does support smaller size clients. We generally find it works best in an environment of 75 or more employees. And it can work in lower numbers, absolutely. You just find the HR team generally starts needing a performance management solution when they get to around that size. And that's why it's targeted there. And I think those are the questions for today. So I appreciate everyone taking the time to join us. Certainly, if you have any other questions, reach out to us. You can contact us at the number listed on the screen or via email at crg@crgroup.com. And certainly look out on our site for things like our controller corner videos, which you can see at crgroup.com/controllers-corner. And remember the products that I talked about, for many of them, there are free trials available against GP's Fabricam company. And if you have any other questions or concerns or anything we can help you with, please reach out to us and let us know. I appreciate all of you taking the time today. I wish you well. I hope you're doing well in these unprecedented times we live in. And hopefully the whole world's getting a lot better here as our summer progresses. Thanks very much, everyone.